Stock market plunges. Consumer economic survey hits the lowest level on record as layoffs soar to the highest level in 22 years. And is de-dollarization back? What is going on? So here we're taking a look at the NASDAQ, down about 5.3% on the week, taking another sharp leg lower today. We'll get to what is going on, why this is happening. But the NDX, or the NASDAQ, down about 4% just over the past couple days alone. Now, the government is shut down, and that is contributing to some of this. We'll get into that in a second. But we still, while we might not be getting government data, we still get things like the University of Michigan consumer expectations, current economic sentiment, and some of these are hitting the lowest level in over 75 years in the history of the survey, going all the way back to 1950. So as we can see, consumer sentiment came in at 50.3. The expectation was higher, 53.0. Current economic conditions came in at a 75-year low, the lowest level ever recorded, 52.3, and the expectation there was higher as well. And finally, consumer expectations for the future, those came in at 49.0, again, below expectation. That'll cause volatility and big moves in various markets. So here we're looking at consumer expectations. Again, this is for the future. They are very near lows only seen during, say, the GFC or something like that. Here we're looking at current economic conditions. While TradingView hasn't updated, I did update the chart, and as we can see, it is the lowest level ever recorded, going all the way back to 1953. So in the post-World War II era, current economic conditions have never been this low. This is now even lower than the lows set in the GFC. So this is highly significant here, these readings. Now, if we look at consumer sentiment, again, that came in lower than expected at 50.3. TradingView hasn't updated, but I did update the chart. We are within 0.3 points, 0.3 points of an all-time low. Again, going back like 70 years to 1953, we are very near an all-time low for consumer sentiment, and we'll get into some charts showing why that might be. By the way, here's a chart provided by Zero Hedge, and what I wanted to point to, we are seeing the largest gap for that current economic conditions reading, which again is the lowest on record in the past 75-ish years. The gap between Republicans and Democrats is at the highest level on record. So thanks to Zero Hedge for that. Now, looking ahead to inflation expectations, here we also got some data. 1-year inflation expectations from consumers, 4.7%. That is above the expectation of 4.6%. If we look at 5 to 10-year long run inflation expectations, those came in at 3.6%. That is below the expectation of 3.8%. Here we can see both of those in a chart form. CPI, year over year inflation, as we can see, inflation expectations from consumers are generally not that good of an indicator. You can take a gap here and subtract out and find that inflation expectations from consumers are generally not a great way of predicting CPI. However, inflation has been headed higher for the past 5 months in a row to the highest level going all the way back to January. And of course, if you look at ISM services, prices paid, that component leads CPI by about 2 to 3 months. That has been going vertical over the past couple months. So we're likely in for a higher inflation. Of course, energy had been keeping CPI, or at least the headline CPI, below a 3 handle. Well, we now have a 3 handle. Inflation is now 3%. And by the way, the Fed just cut interest rates, and consumers are not very happy about that. Now, here, by the way, is the difference between Republicans, Democrats, and independents for inflation expectations. We can see that Democrats' inflation expectation, along with independents, both moved higher, while Republicans basically stayed flat. Now, why are consumers so upset? Well, here's a chart that I put out this morning over on X, and this is just one of many reasons. So if you take the S&P 500 and divide it by the average hourly wage, you get the number of hours of work, average work, needed to buy one share of the S&P 500. Now, Boomers, the average back here from the 1960s and the 1970s, that average was about 20 hours of work. Well, the number now is 213 hours. That is a 10x increase in terms of the amount of time or labor or human energy that you have to put in at the average job in order to buy one unit of the S&P 500. So, of course, this is one of many reasons, at least for younger folks, when Trump goes out and talks about how great the stock market is doing, young people can't afford to buy stocks because, again, their wages are not keeping up with the stock market. Put another way, the other way of saying this or framing this is that the S&P 500 stock market has outpaced wages by 914% since the 1960s and the 1970s. In fact, if you look at this and compare the stock market, the S&P 500, this is not even the total return, just the overall index, going back to the end of the gold standard, to gross domestic product and the average hourly wage. If wages here in pink had kept pace with GDP going back to 1971, the average hourly wage would be $104 per hour. It is only about $31 per hour. If wages had kept pace with the stock market going back to 1971, the average hourly wage would be $283 per hour. Now, here's a cross asset look at what's going on in markets. We do see a bit of a safety trade going on the past 2 days. We see bond yields lower. Again, those are inverse to the bond price. So what that means is bonds are getting bid across the yield curve. This is looking at the 2-year, the 10-year, and the 30-year yields. Here we can see the dollar has been selling off. It did break above 100 and has been selling off below that level for the past 3 days. If we look at gold, gold has had a bit of a bounce and is up over the past couple days. We'll get to that de-dollarization. Volatility, the VIX index, the fear index, that is up significantly again today, up to a 22 handle. If we look at SPY, the S&P 500, this is a pretty brutal looking chart. Now, that's not to say a short-term bounce around here probably isn't to be expected, but we are seeing significant amount of volatility. In fact, the S&P 500, you have to go back to Wednesday, October 29th. That is the peak so far, the short-term high in the S&P 500. So really, the stock market has been selling off for about 10 days now. Now, taking a look at the yield curve, here we can see the yield curve has been steepening going back about the past week or the past 10 days or so. Now, there was a bit of a bear steepener in there, but some of it is a bull steepener. We really are going to have to wait another week or two to really take a bit of signal out of the yield curve and what it is doing. But I will point out that the 10-year yield minus the Fed funds rate, that yield is at near the high in terms of the gap. The difference between the 10-year yield and the effective federal funds, you have to go back to January 2025. It was about 43 basis points. Well, right now that is at about 20 basis points, but it is near the high there, as we can see. The difference between the 10-year yield and the federal funds rate, hopefully that is a little bit more clear. But again, yields have been moving higher. If you start the clock, when the Fed started to cut rates here back before the last election, they are cutting interest rates. Again, if we go back to the inflation and take a look at CPI, again, remember, inflation has a 3 handle and the Fed has been cutting rates. If we go back to the yield curve, we can see they cut rates back here in mid-September, and then they just cut rates again with assets at all-time highs and inflation with a 3 handle and probably headed even higher. Now, de-dollarization, I did want to point out, I wake up very early here on the West Coast, and so I get to see kind of the tail end of the European session. And I did want to note that earlier this morning, it is reversed so far. We have gotten that bid into bonds. But what I started to notice back in January, when I started to talk about the de-dollarization trade, way before mainstream media caught on to it, it was because I would wake up early and I would see bonds down, aka yields up. I would see the stock market futures down, and I would see the dollar down. Well, that is textbook capital rotation out of a country in a financial system, out of dollar denominated assets. Now, a lot of times, what would happen, it was relatively minor, and as soon as market opened here in U.S. session, it would reverse. But what I started to notice is that during the tail end of European session around the close, you would have bond yields up, meaning bonds down, bonds getting sold. You would have the dollar getting sold lower, and you would have stocks getting sold. Well, that was when I started talking and flagging the issue of the de-dollarization. Of course, it really started to accelerate into March. And then, of course, April, it got really kind of overheated. Well, this morning, I just want to point out that I was noticing that again. You can see this tail, this topping tail on the 30-year yield. The 30-year yield was actually up significantly, about 4 basis points. The dollar was looking very similar to how it looks now, down. Right now, the Dixie's down about 0.25%, and the S&P 500 was set to gap down lower. So you had bond yields up, aka bonds down, bonds getting sold. Then they don't want dollars because a bond is a dollar denominated asset. So they then sell the dollar. So the question becomes, okay, well, what was up? That was my question back in January. And back in January, all the way through April, May, when de-dollarization became a popular topic, well, it was the Swiss franc, it was the euro, it was gold, and it was the yen. Well, this morning, it was the Swiss franc, it was the euro, and it was gold. The yen was actually down. So just wanted to point that out. I thought it was notable that you had, especially with weak economic data, that is really what is important. What you don't want to see is when bond yields are going higher, despite the fact that you have challenger job cuts coming out with the highest level of layoffs in 22 years for the month of October. You don't want to see bond yields at the long end, especially moving higher. Again, that is what emerging markets in a debt crisis, what you start to see. And then, of course, you see their currency getting sold because no one wants to be in the currency that is about to get printed away. And then they don't want to be in equities either. So you see equities down. So just something to keep an eye on. I'm starting to see signals of that again. And I was quite early catching it the first time. Just wanted to flag it for those of you that are the loyal viewers. Very much appreciate, of course, everyone that views the channel. But this is really, really, really a sign of the times, I think, that you have consumer sentiment so low, current economic conditions so low. It's really, 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 I think, a sign of the times. And politically, of course, you see the response to this in New York City. There's a rise in populism, just as we've been saying and calling for since the channel started in April. You're seeing that rise in populism. Well, remember, populism is very, very, very bad for financial assets, not gold. If you go back to the last period of time, there was political populism in the U.S., the stock market, the S&P 500, in gold terms, in real inflation adjusted terms, lost 90% of its value. Of course, in dollar terms, it basically went sideways. Populism is not good generally for stocks. It's not good for bonds because it's inflationary. There's a lot of spending associated. So anyways, hopefully that was helpful, and I'll catch you in the next